It's a constant struggle for businesses, isn't it, managing cash flow, especially when you got these huge orders going out to big retailers. But the payments take ages to come back in.
It's a real balancing act. And that actually brings us perfectly to today's topic. We're doing a deep dive into this $30 million financing deal. It involves a furniture manufacturer and a company called Versant Funding.
Right. And you, our listener, actually pointed us towards this one. It's a fantastic example, really, of those maybe less flashy but critical financial tools businesses use.
Exactly. So our mission today is basically to unpack this deal. What does it mean? What does it tell us about business finance generally? And we'll try to do it without, getting bogged down in super technical terms.
Yeah, let's keep it clear. So, you shared the press release, a summary which was helpful, and even a little quiz about Versant Funding. So we've got the key info.
We do. Think of this as, well, your quick guide to understanding the specific transaction and, more broadly, why these kinds of financial solutions are even out there.
Okay, so let's set the scene. We have this furniture manufacturer, sells to big names, brick and mortar stores, major online retailers. Suddenly they find themselves needing a pretty significant cash injection.
And the why behind it is interesting. Apparently their previous long-term factoring arrangement, well, it wasn't renewed.
Ouch. Factoring being essentially selling your unpaid invoices for cash now. So if that stops...
That's a huge problem for your day-to-day cash flow, especially if you rely on it.
And it wasn't a small issue either. The sources mention a significant balance outstanding from that old arrangement.
And that specific detail is key.
Why is that?
Well, think about it. If you're a new factoring company considering stepping in, but a large chunk of the money you collect initially just has to go straight out the door to pay off the previous factor, that makes it much less attractive, right?
Okay. So that large outstanding balance would scare off most factors, as the source says. It limits their options significantly.
Exactly. So the furniture maker is in a bit of a bind.
And there's another complication, too.
Yeah, apparently they were also heading towards an imminent corporate restructuring.
Okay, so big internal changes happening. Mergers, reorganizations, that sort of thing.
Could be any of those. The point is, because of this upcoming restructuring, they weren't looking for another, 5-year financing deal. They needed something short-term, a bridge, really.
Right, just something to tie them over. So, tricky situation. Big outstanding balance, need for short-term funding only.
Which brings us to Versant Funding.
Okay, and what's their angle?
Their specialty is providing non-recourse factoring facilities.
Non-recourse. Okay, let's break that down simply. Factoring is selling your invoices, your accounts receivable, to get cash quickly. Versant buys the furniture maker's invoices from those big retailers.
Right, and the non-recourse part, that's crucial. It means if, for some reason, one of those big retailers doesn't pay their invoice.
Versant takes the hit, not the furniture manufacturer.
Exactly. Versant assumes that credit risk, the furniture maker gets their cash, and they're protected if the customer defaults.
That's a significant difference from recourse factoring, where the manufacturer would have to cover the loss.
Absolutely. And it ties into Versant's stated focus. They look exclusively on the credit quality of a company's accounts receivable.
Meaning they care less about the furniture maker's overall books and more about how likely are those big retailers to actually pay their bills.
Precisely. Is the retailer creditworthy? That's their main question.
Which makes a lot of sense, especially if the furniture company itself is maybe going through some financial turbulence or that restructuring.
Right. And Versant isn't just dealing with small amounts. The sources say they handle clients with B2B or B2G sales, so business to business or business to government, from $100,000 up to, wow, $30 million a month.
$30 million a month.
Right.
Okay, so they have the capacity for significant volume. That $30 million facility for this one furniture maker fits right into that scale.
It certainly shows they can handle large, complex situations. And we had that quote from Chris Lehnes at Versant.
Oh, yeah, the business development officer.
Yeah. He highlighted their ability to fund these bigger deals and also their flexibility in creating bespoke factoring solutions.
Bespoke meaning tailored, customized.
Yeah, basically not just an off-the-shelf product, but something designed specifically for that client's unique needs, like maybe specific terms related to that restructuring timeline or how to handle that outstanding balance.
Okay, so thinking strategically then. For the furniture maker, choosing this non-recourse option with Versant instead of, say, trying to get a traditional bank loan, what's the big advantage?
Well, like we touched on, banks often look at the whole picture, right? Assets, liabilities, profitability, history. If a company is restructuring or has maybe weaker overall financials at that
A
moment,
bank loan might be tough to get, or the terms might be unfavorable.
could be. But Versant's focus is narrower. It's on the quality of the debt owed by the customers. If those customers are solid, big-name retailers,
Then Versant is more willing to provide funding because that's the primary collateral they care about.
exactly. It unlocks cash directly tied to sales that have already happened based on the strength of the end customer, not necessarily the seller's current balance sheet strength.
That makes perfect sense in this context. Versant's specialization really seems like a direct fit for what this furniture maker needed, especially with that prior balance issue looming.
Yeah, it seems likely that their focus and capacity were key differentiators. That $30 million number isn't trivial. It shows they could absorb the risk and complexity that maybe others couldn't or wouldn't.
And the fact it was a short-term facility, let's unpack the implications of that a bit more.
Okay. For the furniture manufacturer, it's pretty clear, right? It's bridge financing. It gets them through this restructuring period without locking them into a long-term debt obligation that might not fit whatever the company looks like post-restructure.
Gives them breathing room and flexibility.
And for Versant, offering a short-term deal means their risk exposure is limited to a specific defined period. They need to be confident those retailers will pay up within that window.
So maybe a slightly different risk calculation for them compared to a 5-year deal. They need faster confirmation of payment reliability.
Potentially, yes. It concentrates the assessment.
You know, it also makes me think about the mix of retailers. The sources mention both brick and mortar and online.
Right. Established chains and maybe newer, faster-growing e-commerce players.
Does that present different kinds of risks for Versant, do you think? Assessing a huge, established department store versus a purely online furniture seller?
Well, the sources don't really go into that level of detail, so we shouldn't speculate too much. But you'd assume a company like Versant, operating at the scale, has robust methods for evaluating credit risk across different types of retailers that have to.
Fair enough. Stick to the sources. But it does lead to a broader thought.
Which is?
Well, this whole situation highlights a very specific need: short-term, non-recourse factoring for a large amount, complicated by restructuring and a previous balance.
Yeah.
It makes you wonder.
What other kinds of specialized financial tools are out there?
Exactly. In this business world that's always changing, with unique industry pressures, what other niche financing solutions are popping up? Beyond factoring, what are companies using to solve very specific, maybe unusual cash flow or funding challenges? Something for you, the listener, to ponder.
That's a great question to leave folks with. What's hiding in the corners of corporate finance?
So just to wrap up our deep dive today, we looked closely at this $30 million deal. Versant Funding providing non-recourse factoring to a furniture manufacturer in a bit of a tight spot.
Yep. We explored why they needed it, the old facility ending, the big outstanding balance, the restructuring, and how Versant's specific focus on the quality of accounts receivable, their capacity, and that non-recourse structure made them a good fit.
It really illustrates how these tailored financial solutions work in practice. Thanks again for sharing these sources. It was genuinely fascinating to dig into.
Glad we could explore it.
And to you listening, what other deals, financial mechanisms, or business strategies have caught your eye recently? What else do you think warrants this kind of deep dive? We'd love to hear about it.